Hello, everyone, and welcome to the January 2023 issue of the Zavitz and Sykora Financial Strategies newsletter. Thank you for tuning in and listening to our update. I'm your advisor, Greg Sykora, and joined with me today is my partner, Mark Zavitz. Today, we're going to provide you a very quick update. We're going to go over the 2022 calendar year performance. We're going to cover our model portfolio performance before we quickly move on to highlighting the RRSP and TFSA contribution limit update. So let's get started. So when it comes to our portfolio performance, the Zavitz and Sykora Financial Strategies model portfolios have started performing extremely well. They're off to a hot start for the year. So far this year, the very conservative portfolio is up almost 4%. The conservative and the moderate portfolio is up almost 5 or around 5%. And the growth portfolio is up around 5.5%. That's in the first 3.5 weeks of this year. On a 1-year basis, we're only down somewhere in the ballpark after fees. Most clients between 2.5%, 3% to around 1.5%. Now, that's not the number you see on your screen because I'm also including the fee-based service fee that goes into your accounts. But this performance on a relative basis is pretty good. We're looking at the different indexes. We're looking at the different stock markets, the bond markets over 2022. And most client portfolios that we rebalanced over the course of the year, they were rebalanced sometime in the spring or the summer or the fall. So this isn't inclusive of the previous portfolio that you were invested in, but as you can see, these adjustments that we made, these tweaks to adding ETFs to most people's portfolios have started to pay dividends, no pun intended. So very happy with the outcome so far. Just note that this might not be the exact performance that you see in your accounts because you might not own exactly the full moderate or full conservative portfolio. But in general, the number that you see on this screen plus our service fee included in there is what you've experienced from a performance standpoint. So it has been quite nice and quite good so far. Moving on to our next slide, let's talk about 2022. 2022 sucked. It was one of the worst, if not the worst year ever to retire. The reason for that, nothing went up. The only thing that actually did well last year was cash. All asset classes, be it from the stock market indices that we're seeing on the screen from a total return standpoint, to the bond indices, which I'll show you on the next slide, to the value of hard assets, be it collectibles, antiques, or your home, everything was down last year. Anywhere from the ballpark of around 5% if we look at the Toronto Stock Exchange, to the NASDAQ being down over 30%. If you look at the far right column, total return, there was really no place to hide. And we obviously know what caused that. It was inflation. It was uncertainty with the war in Europe. It was geopolitical risk. All of these things contributed to, markets being down, things being ugly, and stock markets correcting, having some mean reversion. So if we think about your relative performance, and then we look at the total returns of the different indexes, of the different equity indices that you see on the screen, I'm pretty happy with the overall outcomes. Most of our clients, or almost all of our clients, have enjoyed, especially those that we've rebalanced so far. Moving on to our next slide, where we look at the bond indices in Canada. You've got the FTSE Universe Bond and the FTSE Canadian All Corp Bond. Look at the far right column. It shows that these very safe indices, which are typically flat in bad years, at a worst from a performance standpoint, actually were down almost 10% or slightly over 10%, down 11.7%. This, again, if you've talked to us, if you've done your review meeting where we talked about why this was happening, this again was caused by inflation. And in our previous updates, we talked about inflation having a negative impact on bond prices. It affects yields. As yields and inflation go up, bond prices go down, and you experience a capital loss. But the good thing is that now those bonds in your portfolio, instead of yielding 1% like they were a year or two ago, they're now yielding 3, 4, 5%. So we're actually going to make something from the bonds in your portfolio. And we'll actually talk about expected returns on a slide coming up. Now, this, in a nutshell, is something that Mark can speak to, but it just goes to show the different asset class returns over various years, starting from 2008 all the way to last year. And just goes to show that we have no idea what's going to be the best performing asset class in your portfolio, which is almost advocating for having exposure to all these asset classes, which is what that ETF inside of your portfolio does. Mark, do you want to add some color to this, since there's a lot of color on the screen already?
Yeah, this is a very interesting slide that many of the financial companies have been putting out for a couple of decades. And as you said, Greg, it just supports the idea of portfolio diversification. The best performing asset classes in one year often become the worst performing asset classes the next year, and there's very little continuity or any rhyme or reason to this. It makes it very difficult to do market timing. Actually, it's impossible. So, this slide, as you said, speaks to portfolio diversification when we're doing portfolio construction, and you're right. The exchange traded funds are extremely diversified, and they pick up all these sleeves. There's no guessing. The portfolio has exposure to all this stuff, and since it changes yearly, it's best just to cover all the asset classes and in a well diversified portfolio. So, as you mentioned, cash last year. Cash is rarely the number one asset class, but 2022 being so difficult for both stocks and bonds, cash was the winner at 1.5 or 1.6%. We started the year in January 22, and cash was earning clients maybe 3 to 0.4%, and we ended the year with cash accounts making 3 to 4%, and thus the average for the year was around 1.5. Anyways,
Yeah,
and it's an interesting slide, Gord.
The important thing that you just mentioned, I think, is that as we look at how cash performs on a relative basis to the other asset classes, when cash has a good year, in the following year, it's typically the worst thing to own. And that really speaks to, I think, market psychology of when do we typically rush to cash? Well, we rush to cash when all of the other asset classes are underperforming, typically the stocks and bonds in your portfolio, and we do it at the worst time. When we've noticed that GIC, which is a cash instrument, is doing 4%, but the rest of our portfolio is down 5 to 10%, we think to ourselves, well, why not get into the GIC? Well, we do that at the worst time. It's always what happens for most investors that get scared and can't be talked off the ledge. They end up shooting themselves in the foot, because what precedes the cash outperformance is typically stock and bond outperformance. So, and I actually got another slide that we'll be showing this few seconds that speaks to that.
Yeah, and it isn't, Greg, it isn't just cash. It's any asset class. Unfortunately, most of the money flows into the asset class after the asset class has done well, or appears to be doing well, and that is again something that speaks to diversification and just setting up a well-constructed portfolio and just holding your guns and letting it do its work, right? Year after year.
Exactly. And if you were a higher risk investor and say you dabbled in stocks over the past couple of years, you were an idiot if you didn't buy any of these names or most of these names. And in fact, most portfolio managers, most do-it-yourself investors, most investors in general, if they were buying stocks, they were typically loading up on these stocks last year because the performance had just been so good. These are US large cap stocks. They're multinational, but they're considered US large cap stocks. And they were the best performing asset class based off the previous slide in 2021. And when, as an investor, would you have bought them? Well, you would have bought them midway through 2021. And what would have happened? Well, you would have held on to these stocks thinking, great, these things are doing double digits on a year-over-year basis. This is easy. I'm just going to continue to buy these stocks. Well, what happened last year? Well, last year, these stocks got absolutely wiped out. Any fund that focused almost exclusively on tech experienced crappy performance because it mostly owned these stocks. And when would you have bought that fund, or when would most advisors have recommended clients like you buy that fund? Well, they would have recommended it in 2021, and then unfortunately clients would have experienced really bad performance. So it just goes to show no one can market time. When the recommendation, or when all the talking heads on all the different news outlets that cover stocks are saying you should be loading up on these names, it's typically the worst time. That's when the herd mentality kicks in, and unfortunately people get burned. They buy these, they go down 30, 40, 50, 60%, like what just happened. There's mean reversion that happens. And unfortunately, investors are left holding the bag, and it can really screw you if you have too much of a concentration in these names. So luckily we know a few clients, that own some of these names. Most clients have the majority of their investments with us, and you do get exposure to these names in your portfolio, but there's not a concentration. And Mark and I don't believe in buying stocks for clients like you for exactly the type of downside and risk that we see that can happen in owning individual names. Going down 50, 60, 70% is not the ride we believe in for our clients. The good news, and if we've done a review with you lately, we talk about the fact that your portfolio was down 2, 3, 4% at the time. The good news being that expected returns for the different asset classes that are in your portfolio, predominantly what we're seeing on this screen, are looking quite good. Now, this is as of November 30th, 2022, or December 1st, basically. The expected returns for bonds, if we were to look at a similar 5-year expected return chart in 2021 heading into 2022, expected returns for bonds were only around 0.5% to 1%. So now that yields have come up, although we've experienced some losses in our bond portfolio, yields have come up, and now bonds are making us 3 to 4%, which is great. We're getting some return in the bond sleeve. And stocks, because they're down, the expected return for stocks, and we own almost all these asset classes in your portfolio, is somewhere between 8 to 10%, which is great. So if you own the conservative portfolio, if I were to do a ballpark weighted average of the expected return after our service fee, it's somewhere in the ballpark of 4 to 6% annually over the next 5 years. 4 to 6% return compounded annually over the next 5 years, I think, is a great number. Our moderate portfolio is probably somewhere in the ballpark of 5 to 7, and our growth portfolio is somewhere in the ballpark of 6 to 8% after fees. I think these are all numbers that we can live with. Again, we try to hit singles and doubles. We're not trying to hit home runs. If we're going to end things right now, if we're going to speak to something real quick, we're going to be sending out an email blast, or it's going to be part of this recording, just reminding you that if you do have a tax-free savings account, if you do have an RSP account, your 2023 tax-free savings contribution can come in now. We can take it from existing assets, or we can receive new monies from you, but we'll be contacting many of you individually. If we don't get to you, this is just a reminder that you can reach out to us, and we can send you instructions to send that tax-free contribution. For 2023, it's $6,500. The lifetime amount has increased to $88,000. So if you don't have a tax-free savings account and you would like to contribute, assuming you're 13, 14 years ago, 18 years of age, your lifetime tax-free savings account amount that you can contribute is $88,000. If you'd like to make an RRSP contribution, the amount has increased this year to around 30 grand. Last year it was around 29 grand. You're still able to make a contribution for 2022 until March 1st of this year. So if you want to make an RSP contribution to count against your 2022 income, the maximum you can put in is around 29 grand. And it's 18% of a maximum income of $171,000. We still have around a month to make that contribution. So please reach out to us, because this requires a little bit more financial planning in order for us to determine if it's a good idea or not for you. Please reach out to us directly if you would like to make that contribution. Thankfully, with our new portfolios that have ETFs, we also have the ability to receive online bill payments from you. So you don't need to come in and give us a check, but we will happily receive a check from you if you'd like to come in and see us in person. But you can make it from the comfort of your own home through online banking, should you want to send us an RSP contribution or TFSA contribution that way. I don't know if there's anything to add, Mark, before we end things. It's been about 16, 17 minutes, this video. Anything you want to add?
I'm good.
We're all good. All right. Thanks everyone for tuning in. This is our update for January. We look forward to sending you the next update in about a month's time. We hope you had a great start to the new year. Thanks. Have a great day, everyone.
Care, everyone.